Scott, over the past couple of episodes, you have cautioned that inflation might not be dead. In the last few months, we have had interest rates increase broadly despite the Fed cutting rates on the short part of the curve. Today's jobs report was very strong, which will likely lead the Fed to not cut rates for the foreseeable future. If increased inflation returns, how can retirees prepare?
Well, there's several things that they can do. As you guys know, this is one of the topics that has been near and dear to my heart. I think the first thing to consider when you're looking at inflation on a going forward basis is, do I have true diversification in my investments? That's not just, do I have some stocks and some bonds? It's, do I have various types of, say, equity investments that are going to react differently depending on what's going on in the world? So do I have some growth? Do I have some value in terms of dividend production versus true capital appreciation? Because the biggest growth companies and also smaller companies a lot of times are the ones that are going to outpace inflation the best over a long period of time. On the fixed income side, and this is something we talked about quite a lot in our last couple of episodes, is the longer duration of bond you have, the more impacted by inflation you will be. So if you are going out there, this is something that happened in 2022 and a lot of people got hit, is you buy these inflation protection bonds, TIPS, and instead of getting a good return from those, you're negative in 2022 when rates increase, and you're saying, what is going on here? What happened is that the duration component or the length component of those bonds is really hitting you. So I'd say the first idea is have exposure to parts of the market that can have the potential to do better than inflation. Because fixed income, to do better than inflation, really what you're hoping for is that rates just start to go down at some point. Because if rates stay the same or increase, the best you're going to do is keep pace. You're never going to outperform inflation from fixed income in a rising interest rate environment. With one caveat, and this is something that we could talk about, if we think that we're in a really durable inflationary period, you could look at floating rate bonds. Those are basically bank loans that are made a little bit less liquid than other bonds that you might find in the marketplace, but very short-term bank loans where the interest rate is dependent on the prevailing market rate. So you're going to get a little bit more interest or yield from those types of investments as interest rates rise. The caveat there, bank loans are to almost entirely sub-investment grade credits. So these are borrowers that have a triple C, single B, maybe double B rating. And so therefore you're taking some credit risk in addition to the, if I'm wrong and inflation does not go up, it's maybe starts to come down, I'm going to get a lower coupon. And these are maybe kind of risky issuers that I'm investing money in.
Yeah. And I think, Scott, just so we can kind of disentangle some of the mystery today with the news, and we're not going to get too much into prognosticating on why the market does what it does, but there is sort of this interesting element to what we've seen with interest rates and inflation. And we were talking about that this morning. The Fed was cutting rates on the short end of the curve. And then we got a really good jobs report, which you would think, oh, that's great news. Economic prosperity, people are going to work. And yet the market is down and mortgage rates have hit something like a multi-decade high. Can you untangle that for us? What's going on there?
Yeah. And I mean, one of the things that I caution is if you say that mortgage rates have nothing to do with the Fed rate, there's going to be people who kind of poke holes in that. But generally, mortgage rates are going to be a lot more tied to what's happening in like 5 to 10 year interest rates as opposed to the overnight rate that the Fed is setting. So what's happened over the last couple months is the Fed felt like inflation was mostly under control. They got it back down under 3%. and they felt like, okay, maybe conditions are a little bit too tight to maintain this 5.25%, 5.5% overnight rate where we got to. But on the other side of that, every other bond other than basically the overnight rate that banks borrow from each other in is set by the market, not by the Fed. And so what we've seen is with a new administration coming in that is talking about things like tariffs and maybe deporting a lot of low-wage earners that are here illegally, those are things that the market as a whole is looking at and saying, these might be inflationary. Because if we put big tariffs on Canada and Mexico and China, what it means is that individuals in the U.S., where consumption is a huge part of our GDP, are going to be paying more for goods. So that's one of the ways that you disentangle what the Fed's doing from what's happening in prevailing rates. So now we've seen these 5 to 10-year interest rates get higher. Today we crossed 4.75 on the 10-year, at least briefly. That was seen as kind of an interesting threshold by some people. So we'll have to see if we go even further than that. But I'd say overall, we're returning to what is a more normal yield curve where longer-term rates, you get a little bit more than short-term rates. But on the other side of that, as you mentioned, we're in this environment where good news is bad news is maybe good news in the long run. So it's a little strange because what we're seeing, and this happened several times in 2024, where the jobs reports got revised lower, so less positive in terms of employment data, and the market goes up. And then we have today where the job report is really solid, consumer spending in the holiday season was pretty robust, and the market's down 1.5%. So I think what we've kind of unfortunately done in the last 15 years or so is we've gotten to this place where the market is almost, it's very correlated to even short-term movements in interest rates. So we saw in the aftermath of the financial crisis, rates go to and stay at zero for a really long time, or virtually zero for a very long time. We had negative interest rates in Switzerland and some European countries. So cheap money prevailed for a decade or more. And so now I think the market as a whole is struggling to adjust to the new normal where they're not going to go back to 1%. Because if that happens, we've seen inflation come back. We've seen 8-9% inflation in 2022 or 21. We know that's in the background. So if rates go that low, it's almost a foregone conclusion that inflation is going to come back.
So we have a lot of clients who are looking into the bond markets and seeing for the first time, and as you mentioned, a long time, very attractive yields. Mm-hmm. And that might be an indication to rebalance portfolios and own more fixed income. But from our perspective, and it sounds like from your perspective, you'd probably caution a person on that. You'd say, yeah, yields look attractive, and you might be able to get a higher return on that portion of your portfolio that isn't incurring as much risk, but there are some hidden risks to over-allocating to bonds right now.
Yeah, and I think the biggest one is the one that I touched on a second ago of just if rates continue to go higher, then what that means is that every day you're losing a little principal value in a fixed income investment. So say today we're talking about buying a 10-year bond at 4.75, and I'm going to use some round numbers in talking about this. If the 10-year treasury goes to 5.75, so up 1% from where it is today, you're probably going to lose principal value on that original bond investment, something like 9%. And that's a function of the duration or the length of the bond. So yes, you're going to get your 4.75 and that's going to offset that loss. But then each year you have to be considerate of, okay, if rates just keep going up, I'm going to constantly be losing a little bit of principal. Now, eventually, as that bond becomes a 2 or 3 year bond, maybe 7-8 years down the road, the impact on rising rates is going to be less, but you just have to be cautious about over allocating to a bond portfolio that is of a longer duration. So I think while we're in an uninverted yield curve environment now, I would caution people to stay pretty short on the length of their fixed income investments, because you can get, say, 4.5 fairly conservatively, and with those types of investments, you don't have the risk of losing 12, 15% if rates really run off from us, because we know they're going to mature quickly and you can reinvest at higher rates.
Yeah, and that was great. It's a good allusion to our previous discussion on the 60-40 portfolio, which some people had feared had died in 2020.
Talking about death a lot.
We are, yeah. Well,
these last couple,
weirdly enough, but and we would caution the listener today, it's not dead. It's just it was used improperly, hired to do the wrong job. And you alluded a little bit earlier to traditional hedges against inflation, and maybe without running afoul of the Bitcoin crowd, we can talk about some of the more traditional measures that a person would take in their portfolio to maybe provide a hedge, and why you might caution people against investing in commodities, particularly trying to time the commodities market, how fickle those markets can be, maybe touch on a little bit of gold, maybe touch on how a hidden hedge against inflation tends to be a primary residence or some real estate things, and then how stocks kind of perversely benefit from inflation in a way, because inflation at its core is too many dollars chasing too few goods. And those goods can include operating companies. And so why stocks, not just because they grow faster than bonds, but because they can actually benefit as an asset, might also prove to be a sensible hedge against inflation.
Yeah, and I think there's that too many dollars chasing too few goods. I mean, every exuberant market of the last 5 or 6 years, you could kind of tie to that to some degree. We're seeing, I don't know, I'd have to go back and look at the data to make this a really solid claim, but the feeling that a lot of people get is that when the market's running, it runs faster than maybe it did 20, 30 years ago. That may just be a recency bias, but it does seem like the fact that everybody, or say everybody with a 401k is dumping money into, say, the S&P 500 and similar vehicles, the total market index, stuff like that. And so these things kind of have a bid in the background, or a minimum amount that people are willing to pay them regardless of what these companies are doing. So that could be a long-term driver of inflation, but it also could be a long-term suggestion that, hey, maybe there's a big correction coming in the market. But going back to some of those maybe more traditional inflation hedges, you mentioned commodities, and gold is one that is brought up quite a bit. It's actually had a pretty nice little run the last few years. Its best performance probably since the 90s or maybe early 2000s. I'd have to go look at the data. My primary caution on gold as an inflation hedge is, when a person is retired, what do they need? They need spendable income from their investments, whether that's Social Security, whether that's an annuity, whether that's dividends. They need cash to cover the things that come up. So whether that's rent or a mortgage or groceries or travel, whatever it is you want to do in retirement, you have to have spendable cash to do that. Gold will never provide it. There's no, gold is a rock, just so that everyone's clear on that point. It's never going to pay you for owning it. It's not, it's not altruistic. It doesn't pay a dividend, like you said. So what you're hoping for with gold is that you're going to buy it, and at some point you're going to make the enlightened decision to sell it at a really attractive point in time. What I tend to see in people's portfolios with gold is they buy it and they hold it forever. And maybe that makes them feel good that they have a small allocation to it. But in terms of everything having a use case, which I would say in a retirement portfolio, everything should be usable. There should always be a point in time where you say, this investment has served its purpose and we're going to now turn it into cash. Gold struggles as that particular investment.
That was so well said. And you can comment on this in your career. It's been a little bit longer than mine. we've seen some clients get the buy side of gold correct. Where we feel like there's an inflationary environment coming down the pike, and we get some clients who will allocate a portion of their portfolio to gold. Have you ever seen a client get the sell side of gold right? Has a client ever been like, you know what? This is the point of maximum pain, inflation-wise. My bonds are in the toilet. My stocks are struggling, particularly my small cap stocks. I'm going to turn some of this gold to cash and either reallocate to some of these now underpriced assets, or I'm going to cover my next year's income needs with this phenomenal investment that I made in gold. Has anyone ever successfully done that?
I'm going to say no. It sounds like I'm just trashing on gold now because and there's a case to own it. Yeah. There's a case to own it. And if you're willing to sell it, I think there certainly is a case to own it. In my experience, the best cases with gold are that you sold it at a time to get some tax losses, and you use those tax losses to offset other gains.
Yeah, I mean, that's been my experience where we get people on the buy side, they own some gold, or they've just owned some gold for a really long time, and all of a sudden it's their best performer, but they discover right at the time of maximum pain, they're the least willing to offload the gold and turn it into cash to either buy an undervalued asset or cover their income.
It's kind of the same phenomenon of, so we work with a lot of people who have retired from the energy industry in Houston, Texas. And when right now, most of the stocks, Exxon, Chevron, ConocoPhillips, those types of companies are trading not at their all-time highs, but within shouting distance of them. You know, most of them hit them in 2024 at some point. And overall, the inclination to sell those companies, if you had some from your employment at them, was fairly low. A time in which people wanted to sell those companies was during COVID, when they were trading below their book value. So our view of when to sell things, unfortunately, it's a little bit like gambling. You know, losses, they hurt worse than winning feels good. So when you've done really well on a gold investment or an energy company investment, you're probably not going to sell it because you're going to look at it and say, hey, this is the best thing in my portfolio. Why would I ever part with this? When the long-term total return potential of those things probably less than the stuff that you're really down on.
It's one of my favorite analogies is a basketball player who they always feel like it's their opportunity to make the next three-pointer, because if they've missed 5 in a row, they're due. And if they've made 5 in a row, they're hot. And
yes.
It's the same way people view owning gold. I think here's kind of a big question. You don't have to get too much into the specifics, but it's January. It's time for people who are going to take a good hard look at their finances and perhaps get some things either rebalanced or just kind of set for 2025. We've had 2 really good years in the equity markets, 2023, 2024. Those were banner years. I think the S&P 500 cleared 20% in both of those years. We could look at the data to get it exactly right. In bonds, they limped along after 2022, but they actually had a pretty good year in 2024, particularly high yield bonds. What is the case for rebalancing right now? So say you had a 60-40. We talked about that on our episode yesterday or our last episode. And now you have more something like a 75-25. Maybe it's not quite that dislocated, but something like that.
Yeah.
Taking some gains off the table, rebalancing to bonds right now with this inflation kind of running hotter in the background than we anticipated. Would that be indicated? Or would you say, you know what, we might get a little bit of a underperformance this year in equities. That rebalancing is going to occur organically given sufficient time. Stick with your strategy or speak with your advisor, probably the best advice.
Yeah. I mean, talk to your advisor is the best advice, but I would say generally I'm not opposed to taking some gains off the table right now. And it's not because I think bonds are super attractive or that stocks are really overvalued just from a fundamental perspective. It's more so that, again, in retirement, what you have to have a line of sight on is, how do I get through this year? How do I pay the property taxes that are due in 3 weeks or something like that? And the more investments that you have where you pretty reliably know what they're going to do for you, I think that's a win for most people in retirement. So taking a little bit of that, say 15% growth in your overall allocation, moving it back to conservative bonds at a time like this, that seems fairly attractive. I think the other thing that I'm concerned about, if we think about this in maybe re-entry of inflation, as Hannah mentioned at the beginning of the podcast, really good job results that were announced today, good consumer spending. It seems like the economy is doing well. I think to some degree what the market is doing in its pullback today is saying, okay, we know we're not going to get a rate cut in January. We might not get one for some time. I think the market is signaling if we need to reverse course and say the next move in rates is higher, not to predict just doom and gloom, I think that's going to be a significant pullback. Maybe more than, a 2% that we're seeing today.
Yeah, and it has been historically.
Yeah.
Anytime interest rates have gone up, I think people immediately think, okay, we got to batten down the hatches. And that kind of from a coldly mathematical perspective, when we talk about stock investing, which is you've got to entice some money. You've got to get some people to take some risk. And why, if you could earn 5% at the peak of money market rates, why would you put that money at risk in the stock market? Because a lot of people ignore inflation. They think, well, I'm clipping 5 on a bank deposit. Why would I ever put some money into something more enterprising than that on the promise of earning, 8 or 9? It's like, well, we got to get those returns up some, right? Your anticipated rate of return in a stock needs to be like 10 or 12 in that environment. And the only way to do that is to have prices come down. So it kind of follows that interest rates go up, prices on stocks come down. We can bring some of that risk off money back into risk on, and then things tend to equalize. So I think that you're right. A pullback could be indicated if we get interest rates going up. However, running in the background of that is you'll probably do okay in shorter term bonds.
I mean, and this is something that I tell people all the time is, if you're super happy with every part of your portfolio at every moment in time, then it probably means that you are over concentrated in something because you're playing a game that you're bound to lose eventually.
I would interject with one of the best Scott Bartosh quotes of all time, which was, we're going over the portfolio performance of a client. And he said, now the returns we've gotten from the various parts of your portfolio are reassuringly varied. And I was like, that's exactly right, though. It's exactly right. Because if you had a portfolio that was 100% positively correlated, you've set yourself up to go cascading over the edge. Because what on earth would tell you that, oh, I've got positive results from every part of my portfolio? Well, the equal opposite of that is if things turn against you, you're going to get negative results from every single part of your portfolio. So a reassuringly varied portfolio of assets, that makes a lot of sense. Even though it might not feel good to look at small caps and be like, dadgum, these things haven't done anything since 2019. What is going on there? Should we continue to own that? And I think our conviction largely has been, probably.
Yeah,
probably should.
Yeah, you probably should. And because again, it's a component of the long-term game on inflation. So over the last 4 or 5 years, small cap, international, emerging markets vastly underperformed U.S. equity. Will that be the case forever? Maybe, but if you look at 100 years of market history, it would indicate no. That when these disjointedness between returns of these asset classes gets really, really far, typically what it indicates is one of those things is going to start to catch up. Now, I think the caveat there is the U.S., through immigration and just really robust economic growth over the last decade, innovation seems to be in a little bit different place market-wise from the rest of the developed world, Europe and Japan in particular. Those places, they have bigger demographic problems than us. So maybe we're entering a period where they just underperform, and those asset classes have a long-term growth rate of 6 as opposed to 9. I'm not going to suggest that that's exactly where we are today, but you could make an argument that those fundamental differences in, say, the U.S. versus Europe could lead to the U.S. being a higher long-term performing asset class on a go-forward basis.
Yeah, and I think that you're hearing a lot of whispers of that, which might indicate in a portfolio questioning whether or not being 100% U.S. is adequate diversification. Maybe in a bygone era that was considered inadequate diversification, but I think now the range of companies and the things that are going on, particularly on the more innovative side, if you are willing to part with just buying a market cap weighted index, there's nothing explicitly wrong with doing that. But as we discussed on our previous episode, they had to issue some warnings to their shareholders about concentration risk in the S&P 500 because the top 7 companies now account for 30% of that portfolio. Could not launch a mutual fund with that level of concentration today. So if we're talking about owning I'm 100% US, I'm 100% S&P 500, we might argue, well, hang on, that's not adequate diversification any longer. But that doesn't necessarily mean pile 50% of your money in an international stock.
No, it doesn't. And I would say the other thing that has happened, and there's a lot of these a lot of international strategies now are global, which indicates that the manager of that account, or excuse me, of that fund, as an example, they can look both in the U.S. and abroad to make investment choices. That's a nice in-between for a lot of people because it allows you to get the best of the best companies in Europe and Japan and Southeast Asia, but maybe you don't get, a ton of big European banks that have kind of stagnated and haven't grown in a very long time.
Yeah, so you can get a little bit more of a selective effect in a global fund than you would if you were just purely because what is in a European growth fund these days, if such a thing exists?
Ferrari, Louis Vuitton,
For the
Innocence.
luxury brands. Okay.
Yeah. And then one final note on the overall allocation, and you mentioned it earlier, I kind of skipped over it. Your house is a nice inflation hedge. Will it always outperform inflation? No, but it's another diversifier. So if we're thinking about stocks, bonds, commodities, real estate, say you get a period of 10 years and 3 out of 4 of those keep up with inflation, that's a win. In my book, is everything always going to outperform inflation? Probably not. But if you look at real estate, stocks, commodities, and fixed income, I would probably suggest that real estate is the second most likely to keep pace or outpace inflation.
It was funny. We were at a conference of some variety or the other through Baird, and there was a group there. I'm not going to name them here, but they had figured they had discovered something really enterprising, which was the 60-40 was out and the 60-30-10 was in. And the 60-30-10 is 60% stocks, 30% bonds, 10% alternatives. And we were talking about how that's not new. People have had this for years and years and years. They've just never considered their primary residence part of that 10. So it's of course, you got better risk-adjusted returns with 60% stock, 30% bonds, 10% alternative investments. But that doesn't mean you should go out and buy some levered real estate investment trust or commercial real estate fund or something like that. It's no, just consider your primary residence as part of your portfolio, and you've got plenty of exposure to alternatives already.
Yeah. And I think for a lot of people, that math works pretty nicely. Where if you put your home equity in with the rest of your portfolio, maybe it turns that 60-40 into just that 60-30-10 or 55-30-15.
Yeah. And again, I don't think that there's anything magic about the number because whenever they run these analyses, they have to pick something, so a 60-30-10 is fine. But most of our clients, and I think it's wise, don't necessarily consider their home as part of their investment portfolio. And weirdly enough, when we talk to them about making buy and sell decisions with their other assets, we think, hey, look, the constant flow of information you're getting from your online access to the performance of your various funds day to day, it's not helpful. Because you don't, if I showed up at your door every morning and offered you a price on your home, you'd probably answer the door on the third day with a shotgun and tell me to go away. But this is what the market is doing to you every single day. It's pinging you. Hey, would you sell your stocks at this price? Would you sell your bonds to me at that price? It's well, consider maybe it's a little bit more beneficial for people to realize I've got this hedge against inflation in my home, and I'm really glad that the market isn't constantly telling me what it is that they would pay me for it.
Yeah, and this is a little bit in left field here, but I think that that's part of the appeal for some people of like alternative investments and private equity is, one, I think there can be some dubious accounting on those things in terms of what they're reported in terms of their value, especially when things are looking scary out in the markets. But they're marked to market maybe quarterly, as an example. So you don't have to really think about what it's doing every single day. It's not going to be that knock on your door, hey, your fixed income is down 6% today, or hey, your private credit fund is down 10%.
Yeah, because it's not only marked to market quarterly, but they might only offer semi-annual liquidity.
Yeah.
So even if you felt the need to sell it, you're like, well, I've got twice a year. And when that rolls around, the world could be fundamentally different.
Yeah.
Now, so I would caution, I'm sure the kind of point of that discussion is, don't run out and buy some alternative investment that's needlessly expensive or illiquid when you probably have significant alts in your portfolio already. If you own more than just your primary residence, land, other forms of real estate, or just your primary residence, you're probably covered from the alternative perspective.
I think you very well could be. So one other thing I was just going to touch on, and I think this is a kind of a final important note on preparing for inflation in retirement, is I would highly suggest that once you get to the point where you're touching your investments to live off of, that you have some flexibility in the way that you spend. And what I mean by this is not, I'm going to eat this month and I'm not going to eat next month because the market's bad. What I mean by this is everybody has a little bit of an internal bias to doing things or spending money when their investments are doing well. So if you think about, all right, I've got a big Mediterranean cruise planned, you are much more likely to book that and want to pay for that when your investments have been doing nicely. You're much less likely to, say, make that choice if everything around you is red and you look at MSNBC or CNBC or Bloomberg or Fox Business and everything's down.
Jim Cramer's up there jumping around telling
you
to sell everything.
Yeah. So in that environment, not very likely to book your bucket list cruise or something like that. So I think it's important to go into retirement knowing that, all right, I've got some core expenses that are never going to change. I need to pay for the mortgage. I need to keep the lights on. I need to have running water, that kind of stuff. And then with the rest of my portfolio, maybe know, hey, for both the longevity of my portfolio, keeping up with inflation, and my personal happiness, I'm probably going to, I'd rather pay for big ticket items when things are going well. So just kind of know ahead of time that you're going to have core expenditures and then you're going to have the lagniappe expenditures, as I like to call them.
Exactly.
A little extra.
And I know you'd said that was a last note, but I do want to reiterate this, particularly for the younger listeners that we might have. Asset location optionality is a big deal in an inflationary environment. So while you're planning your allocation to your 401k plan this year, do not forget the sage wisdom from Scott Bartosh. Don't over-optimize on tax deferral, because in an inflationary environment, you can see how sinister that might be. You have to spend a little bit more money to cover your income needs, which means you have to withdraw a little bit more money from a qualified account. And with the progressive nature of the tax code, that's not just a linear analysis. That's you can creep from the 24% bracket to the 32 real quick if your living expenses go up sufficiently. So having the option to say, well, look, yeah, it's not, I would prefer not to have to take a capital gain, but it certainly beats the pants off of having to withdraw more money from my IRA this year.
Yeah, and especially as you move towards, say, living off dividends is an aspirational idea for a lot of people. If you're living off dividends in your IRA, you need them to be 24% higher, as an example, to cover your core income needs.
Mm-hmm.
If you have a blend of dividends in an IRA, maybe a Roth IRA, although I probably wouldn't have dividend investments in my Roth. We can touch on that in another pod.
Right.
And then some in an after-tax account, maybe you only need 18% as an example, or 16% more than your true needs. So I totally agree. This is my pet project. As much as you can, save in a brokerage account beyond what you're doing in your 401ks and your IRAs and your Roths.
Scott, Greg, thank you both for taking the time to walk us through this today. And to all those listening, thank you. To make sure you don't miss any future episodes, you can subscribe to the Baird Retirement Management Show wherever you get your podcasts. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. The broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.